Baron to be with us. Standley Réginald Baron is a serious researcher. He is based at Laval University in Canada. He is in the final rounds of his PhD research, but has also worked so closely with the Professor Yusuf Somare, who is also around here in the audience, especially on various projects on a counterparty credit risk, on simulations, on banking regulation, statistical analysis techniques, computer modeling, financial modeling, and what he's going to share with us today is part of his ongoing work. And as usual, we encourage you to make friendly comments, observations, suggestions, points of clarification. And that is the benefit of being engaged in this workshop, to be able to get comments and dissemination, such that after the seminar, this work goes into a trajectory that eventually gets it accepted in a brilliant top-tier journal. Standley will be presenting for 30 to 45 minutes. If you could just post your chat, and then we'll have an engagement with the Standley and Isof and others after the presentation. Okay, Sandra, you are most welcome.
Thank you, Victor.
And without much ado, please go ahead and start sharing your presentation.
Yeah, thank you to introduce me. I'm going to share my presentation. Okay. It's okay?
Yeah, brilliant. Yes.
Okay. So thank you for being here today. The topic for my presentation today is the countercyclical KVA and banks capital structure adjustment speed. There are two topics which has been intensively debated recently in the literature, but in a separate way. In this work, I try to link them because there seems to be a relationship between the KVA and the capital structure speed adjustment. So to understand this link, we need to know what is the KVA. The KVA, capital valuation adjustment, represents the expected cost of holding capital that will be used to support a trade over its lifetime. So to cover market risk and counterparty risk. So this capital increase has a direct impact on bank capital structure, and the bank capital ratio could deviate to the target, and the speed at which banks will adjust their capital ratio will be affected by this cause. So now I'm going to start. Yeah. So after the recent financial crisis, regulators have introduced a set of fundamental reforms to guarantee better stability of the financial system and reduce contagion risk from the financial sector to the real economy. Among these reforms, there are the strengthening of regulatory capital and the holding of capital buffer countercyclical. Based on these reforms, it's important to analyze the cost and benefit of raising banks' capital. And in this paper, I try to answer some important questions which are a real concern in banking literature. So after a deviation of the capital ratio due to the cost of capital requirement, banks should adjust their capital ratio toward the target. So the question is, how quickly banks adjust the capital ratio? And then we observe in the literature a difference in the speed of adjustment of the bank. So the question is, what could cause this asymmetry and the speed of adjustment. And then what strategy or what's the mechanism to achieve this target? So capital structure decision has been intensively debated among modern finance scholars and practitioners. And some important theory like static trade-off theory, the parking order theory, market timing hypothesis have been developed to explain how firms manage their capital structure. These theories pose practical problems when they come to explaining the observed cross-sectional heterogeneity and capital structure and leverage change, say Graham and Lurie 2011. In this context, dynamic capital structure becomes today an important topic. So I'm focused on this literature. So the first group investigate the capital structure for non-financial firms, and the second group for the banks. So they find that non-financial firms and banks have a target leverage and dynamically adjust the leverage toward this target. So recent research has examined the determinant of leverage adjustment speed for non-financial firms. Some important determinants of the capital structure speed of adjustment are equity insurance, transaction costs, and so on. These works are motivated by the fact firms face different costs of adjustment. There is a main source of time vary and the speed of adjustment. However, in the banking literature, I find no existing studies and the literature that specifically investigate the link between the cost of adjustment and bank capital ratio speed of adjustment. Despite that, Ann and Richard 2009 recently considered this topic to be the most important issue in capital structure research. So what I observe in banking literature, they use other factors to explain the speed of adjustment. Like the factor like bank characteristics, supervisory or regulatory pressure, market pressure, and economic condition. As Group and IDA 2010 suggested, banks and non-financial firms have similar determinants of capital structure. So as non-financial firms, I believe that banks' capital ratio speed of adjustment might be affected as well as by the adjustment cost. So the objective of my paper is to fill the gap in the banking literature by showing theoretically how the capital insurance costs could affect the dynamic of the speed of adjustment and testing empirically the role that this cost could play in explaining time varying speed of adjustment. So unlike the corporate literature that use transaction costs and cost of equity to explain the dynamic of the adjustment speed, I use cost of capital requirement linking to a new portfolio derivative transaction for a banks. I approximate this cost by the capital valuation adjustment, that is the KVA. And then I analyze the mechanism to adjust the capital ratio after a deviation. So I expect a positive relationship between the cost of capital requirement and the speed of adjustment. The intuition is that higher capital implies that banks raise the capital ratio that could move them close to the target level, and the speed of adjustment to the optimal target will be faster. Now let's begin to the theoretical model. So to show the theoretical link between the cost of capital and the speed of adjustment, I start with the Modigliani and Miller relationship given by this equation 1. So the cost of equity is depend on the leverage ratio. So, however, Zhu in 2016 point out that the endogeneity is a potential concern in this relationship that could be bidirectional. So I explored the reverse causality of this equation by formulate this equation. So I have this relation between the leverage ratio and the cost of adjustment. And this parameter here could be positive if the expected the cost of equity is higher than the cost of debt. So this relation will be positive. And the cost of equity here for the bank, I will approximate this cost by the KVA. And then I will use this relationship to show all this cost can affect the speed of adjustment. I use a dynamic partial adjustment. So the SOI is the speed of adjustment. So the bank adjusts this capital ratio after a deviation. When I replace this equation here, L, I find the direct link with the cost of equity and the speed of adjustment. Now, so here I estimate the cost of adjustment by the KVA. So now I will show you how to compute the KVA. So we recall that the KVA represent the expected cost of holding capital that will be used to support a trade over its lifetime to cover market risk and counterparty risk. So this definition is given by Albanese, and I'm focused on the capital process here. Following lay summary and summary following, the capital process can be we can simulate the path of this capital by this equation, and the initial capital is given by the unexpected loss. That is the difference between the expected shortfall and the expected loss. And we can calculate the expected loss and expected shortfall by this equation. Now I'm going to show how to compute the countercyclical capital KVA. The countercyclical capital buffer is one of the prudential measures introduced in the Basel to protect the financial system against systemic risk and allow a better allocation of credit depending on the state of the economy. The idea is that banks should increase capital buffer in good condition economy and decrease the capital buffer in bad condition economy. So to consider the countercyclical effect, I use the following equation by Ochino. And according to this equation, the capital buffer is between 0 and U. I have an illustration to see how the buffer countercycling work. Then I use two proxy for the cycle, the ADS index, that's Aruba, Diebold, and Scotty, and the S&P 500. So you see that the buffer is between 0 and 2.5. So 2.5 is the value of U. Then you see that the buffer follow the path of the cycle, proxy of the business cycle. When I use SAP 500, we have this path, and the buffer follow this path. So when the cycle, when we are in the bad condition economic, the capital buffer decrease. The regulator can play with the parameter here, L, to decrease or decrease more the capital buffer. So with L equal to 0.25, and bad condition, the buffer is here, but with L equal to 0.5, the capital buffer decrease more. So the regulator can play with this parameter to increase or decrease more the capital buffer. So we can see that this equation all whatever proxy that I use for the business cycle. So we know that this equation works very well. Then we can simulate the countercyclical KVA. So when we simulate the countercyclical KVA, we have the cycle here, business cycle, like a dummy variable that equal to 1 and good condition economic, and 0 and bad condition. So you see that in bad condition economic, the capital drops. So in good condition economic, the capital increase. So is the idea of the countercyclical. And good condition, banks hold more capital to use and use this capital in bad condition economy. Oh, okay. So now I'm going to present the empirical model and the estimation result. To estimate the speed of adjustment, we use a partial adjustment model. That is the banks when banks observe a deviation for the target level, bank adjusts the capital ratio by this parameter, the speed of adjustment. So this equation is the equation that we see in the theoretical model. Yeah. So then we have the link with the KVA in the capital. We show it in the theoretical model. And then to find the target capital, so in this equation, you suppose that all banks have the same speed of adjustment, but different target level, and the target level depend on the bank's characteristics and the KVA. So when I put this target level in this equation, we have the following equation more completely. So I will estimate this equation to find the speed of adjustment and the impact of the KVA on the speed of adjustment. So we have my first estimation result in the case of homogeneity and the speed of adjustment. So I used three different methods of estimation. You see that the fixed effect method of estimation underestimate this parameter, and the OLS method overestimate this parameter. And the system GML is between the two methods. Yes, so the system GMM is better to estimate this parameter. So we can analyze now this parameter. It is the 1 minus gamma gamma, that is the speed of adjustment. So to find the speed of adjustment, you take this value 1 minus this value. So the speed of adjustment is around 7%. So this means that banks cover an average 7% of the difference between the target capital ratio and the observed effective capital ratio at each time. And the KVA has a positive effect on the speed of adjustment. Banks with higher cost of capital requirement adjust faster. So now we show you the case of heterogeneity of the speed of adjustment. So previously we showed that the speed of adjustment is the same for all banks. Now we consider that the speed of adjustment depends on some factors. I use the factors used in the literature, but I add the capital cost of adjustment, that is the KVA. So in the literature, we use as factor the market pressure captured by the bank with rating BB plus and below, and ING, non-investment grade banks. We have pressure, regulatory pressure. So we capture this by the low capital buffer. So it's a bank with capital ratio below the minimum capital requirement. And we have the global systemically important banks, the G side. Okay, now we have the estimation result for all banks in this column. This column for the NIG banks, low buffer banks, G-SIBs, and undercapitalized banks. So I find that the cost of capital requirement increase bank speed of adjustment. This result confirms my hypothesis developed in the theoretical section that banks with capital ratio that is more sensitive to the cost of capital requirement adjust their capital ratio faster. So I observe that the speed of adjustment varies across banks. You see that, for example, the undercapitalized bank have a speed of adjustment 8% because this bank have the higher cost of capital. And then the undercapitalized bank adjust faster than other banks. It's the same for example. We have the other capital banks have the higher costs, and it adjusts faster. So this could justify the role that the cost of capital adjustment could play in explaining the dynamic and the speed of adjustment. Now, I analyze the when banks have a deviation. So banks take action to close the gaps. So what is the mechanism? So here we analyze the mechanism by which bank adjusts the capital ratio to reach the target level. So to address this issue, I formulate this equation. Here we have the growth rate of balance sheet item. The tier 1 capital, retaining earning, total asset, and risk-weighted asset and loans. And here we have the dynamic speed of adjustment. And here we have the deviation. So once a deviation in the capital ratio has been observed, banks take decision to close the gap by adjusting the capital ratio. This is the speed of adjustment. So we will see the result. So before explain this table, I will to explain the capital ratio is the tier 1 over the risk-weighted asset. So a bank below the target level want to increase this capital ratio. To increase this capital ratio, banks can either increase the tier 1 or decrease the risk-weighted asset, or increase tier 1 and decrease it at the same time. So we observed a difference across banks and the mechanism of adjustment due to the variability and the cost of the capital requirement. Specifically, banks under market pressure, so NIG banks, lower their total asset growth, reducing loan to improve the capital ratio after a capital shortfall. And I note a decline in retaining earnings, which means NIG banks do not accumulate earnings to raise capital, or their earnings decrease due to the drop in loans. Whereas when we analyze the mechanism, the strategy that low buffer banks and GC banks use, you see this bank use increase the tier 1 capital to increase the capital ratio. Now we analyze the mechanism of adjustment with the business cycle. Without the business cycle, we see that banks generally increase the tier 1 capital and decrease the risk-weighted asset in order to increase this ratio to come back to the target level. But when we consider the business cycle, bank generally decrease the tier 1 capital and change the composition of the assets, substituting risky asset with safe one to reduce the risk-weighted asset during economic downturn. So we can say that banks use countercyclical capital to satisfy the market and the regulatory constraints. However, for the GSI banks, and that economic condition, this bank react pro-cyclically by increasing the tier 1 capital and economic downturn. So, in conclusion, in this paper, I show a theoretically link between the capital insurance costs and the speed of adjustment. And I test empirically the role that this cost could play in explaining the dynamic and the speed of adjustment. So unlike the corporate literature that use transaction costs and cost of equity to explain the dynamic of the adjustment speed, I use cost of capital requirement linking to a new portfolio derivative transaction for a banks that I proxy by the capital valuation adjustment, the KVA. And also I analyze the mechanism used by the bank to adjust the capital ratio toward to its optimal target. I find that the cost of capital requirement is the main source of asymmetry and bank speed of adjustment. Globally, banks with higher cost of capital requirement adjust faster the capital ratio. However, the speed of adjustment varies across banks due to the differences in the bank's cost of capital requirement. To achieve this capital ratio target level, banks use different mechanisms of adjustment. Banks under market pressure use asset sides, and whereas banks under regulatory pressure and G-side banks use the liability sides to adjust the capital ratio toward the target level. In addition, I find that globally banks use countercyclical capital, decreasing Tier 1 capital during economic downturn, whereas G-side banks behave differently by increasing Tier 1 capital in bad economic conditions, which could affect the real economy by tempting to ration loans in recession and lead to capital losses. So future works could investigate how the adjustment mechanism of GSIB affect real economy. So this is all for my presentation. I will. I hope you are understanding the presentation, and your comments and question is welcome. Thank you.
Oh, thank you so much, Standley. You presented the paper very clearly, and the paper is also well illustrated with a number of informative tables. I find the work very exciting because for many decades, researchers look into a cost of capital tend to exclusively focus on non-financial firms. They take those samples that exclude banks and other financial services firms from the sample. And in this work, you actually innovate by looking into this important area, but also because the Basel III legislations are providing a challenge, and they revolve around cost of capital issues. So this is a very welcome paper. I'll go straight. Let me see whether I have some comments in the chat room. Oh, there should be some comments in the chat. I can't see any comments in the chat right now, although I did post some comments there in a while.
Yeah.
So I'm not sure where those comments have gone. But let me go straight to the show of hands and see whether participants would like to make, if there's anybody want to make a comment, suggestions, remark. Okay, Charles, Godfrey, good to see you again. I'll take your comment and then I go to Amidu.
Okay, all right, thank you. Can you hear me?
Yes, we can hear you very well, Charles.
Yeah, my background is bad. That's why, not that anybody want to see my pretty face, but I love the paper, and I want to point out that my comments are probably arguably cosmetic. I just want the author to know that that paper by Albansi and what Crepy that you cited, that paper is now forthcoming in Quantitative Finance, and it has two other authors in it, so it's been revised to some extent, and hopefully the revision does not affect the KVA that you use. Okay, so just when you do your revision, just be mindful of that. Point number 2, on page 4 of the paper, you said that you simulated the KVA, but then again, you said you computed the KVA for U.S. bank holding companies. I don't, maybe again, like I said, it's probably semantic, but if you're simulate, to me, okay, for me, this is me as an English speaker, if you simulate KVA on the one hand, and then you compute it on the other hand, specific to a set of companies, I'm thinking that those two numbers are different. And the only reason I'm bringing that point up is that KVA is such a critical part of your empirical analysis that I think, you don't want to leave any doubt whatsoever in the mind of the reader that there could be a possible discrepancy. And then the third point, I noticed that you credited Huang and Ritter in 2009 for pointing out this gap in the literature. I mean, it's incredible that such a gap would exist for such a long period of time. But those are just basically my, the comments I have after looking at the paper.
Godfrey, thanks very much for those absolutely helpful comments, which derive from actually some of the literature that has been cited, and your good understanding of it. Standley, do you want to make some responses or?
Yeah. The first comment I think is here.
The first comment was that the paper has been updated, revised, and is now forthcoming in quantitative finance.
Yeah.
Yeah. So
okay. Why is it that?
You cited the 2018 version.
So I use the functional form of Albanese. I know that there is other functional forms, but the functional form is close to what I'm seeking. So because I use the capital economic capital here, the unexpected clause, and the spirit of Albanese is the economic capital that he used. So the other form use regulatory capitals, something like that. So this definition is close to what I'm seeking. And the other question is, I'm forgetting.
The other thing I had was that you said that you simulated KVA.
Yes.
Yeah. And then right after that, in the next sentence, you said you computed it specific to U.S. bank holding companies, and I want to know if that is an English semantic or if these are two separate things.
When I say I simulate, is that I simulate the capital path year. So when I to find the capital path here, I simulate by this process, and then we can replace year to find to compute the KVA.
So which one did you use in the regression?
The KVA.
So the one the simulated KVA.
Is a simulated the KVAs, yes, in the regression. When maybe it's semantic. When I say I simulate the capital years to find this capital to compute the KVA. So to compute the KVA, I should simulate this capital year, this capital process here.
Yeah, I'm just asking, if I were a referee, that is something I would ask. It's not an important point. I don't want to, let's move on. I don't want to stick on that. I just want to bring it to your attention for clarification if you so choose.
Okay.
Yeah, thanks, Godfrey. And I think what Godfrey was mentioning in the first comment was just to draw your attention, Standley, to the way the paper you cite has been revamped, and there is a new form of it that we need to inform your citation, which is absolutely helpful. Amidu.
Chair, thank you very much for the opportunity, and then also thank Standley for the wonderful presentation.
Thank you.
I just have some few comments that maybe. First of all, the chair made suggested that normally the capital structure theory and then its empirical what do call it, evidence was normally used by firm, by non-banking firm or non-financial firm. And then if you look at the theory that explain the capital structure, both the static and then pecking order theory, both of them were based on the firm, on the non-banking what do you call it, firm. So if you are going to use the same what do you call it, the same theory for banking firm, then you need to have made some assumption. You should have stated some assumption in the sense that the banks are mainly leverage firms. Banks, by their nature, they are leverage firms. So if you want to look at the capital structure of non-banking firm vis-a-vis capital structure of bank firm, they are different, because banks, if you take their funding structure, 90% of their funding structure is made by debt. So you need to have made that assumption for that. And then the second the capital position of banks are regulated. It's a regulatory requirement. For instance, in Ghana here, in 2018, all the banks have to meet certain what they call capital requirement. That's around 400 million what they call Ghana cedi. Those who fail to meet that requirement, they were busted off. So you need to have also make that assumption that capital of the bank is a regulatory requirement. Then the third, if you also look at the Basel III, just as the chair was saying, the capital adequacy ratio differs from country to country. But even though I don't know the data that you use, whether it's only the US firm, I don't have the idea. But you need to also have stated the capital adequacy ratio. So for the empirical analysis, yeah, you were looking at the speed of the adjustment, but you didn't tell us. Your estimation didn't tell us what is the speed for the firm for the cost of the capital to adjust to the normal. We didn't know. Is it 2 years, 3 years, 4 years? What is the speed? And then I also suggest that this type of study, looking at the adjustment, the speed of adjustment, they normally start with looking at whether the cost of the capital itself is persistent. So you could have developed, or you could have used Markov what they call chain to look at the extent and the mobility of the persistence, if there is any. So these are the two. And also there is also a paper. I don't know whether if you can just take a look at it. They published it this February 2020 by Paulo and co in the review of finance. They were looking at asymmetric information and then pecking order, they suggested that the pecking disorder, meaning that the pecking order doesn't follow to some firms. So if we can look at that paper, it will also be helpful. Thank you.
Thank you, Amidou. Very helpful comments. Standley, would you like to give some observations and response where possible?
Yeah, he said that. Yeah, I know that banks is different from non-financial firms, but there are two works that say, for example, Group and IDA 2010 say that suggests that bank and non-financial firms have similar determinant of capital structure. So you find that the bank and non-financial firms we can use the factor on the non-financial firm for the banks. So I'm based on the study to use the same bank characteristic, the same non-financial firm determinant to explain the capital for the bank. So, and what is the other commentary about the
No, I was I'm saying that yes, it's good for you to do that, but you needed to have making some what I call assumption. Is the assumption that so that the reader will know very well that.
Yeah. Okay.
I'm not saying that they don't have the same, but the literature suggests that the capital structure is mainly for non-financial firm.
Yeah, I understand.
My second suggestion was you didn't tell us the speed of the adjustment, even though your estimate.
Yeah, it's about 7% for all banks.
Okay, 7. So how do you interpret that? 7%? 7% of what? But if I calculate, it's the speed.
So banks close the gap by 7% each time. The gap between the capital observed and the target level.
Okay, so it means that the data, is it annually or semi-annual or monthly or quarterly?
Monthly.
The data
because I use monthly data.
Monthly data. So it means that we're talking about the 7. It takes banks 7 months to adjust their speed to normal. What that's that's normally the interpretation.
Yeah, but I have a other indicator. It's not in the PowerPoint, but in the paper, that they calculate the exact adjustment speed annually.
Okay. Okay, and then my last suggestion was either maybe as a robustness check of your earlier, if you can use Markov chain, but I don't know whether it will be appropriate for you to use
Markov chain to
calculate the extent of mobility of persistence. Normally, the study on adjustment normally prelude with whether the costs or the profit itself is persistence. That enables you to see whether if the profit is persistent, then what is the speed for which we can adjust this type of persistence. Just a suggestion, if you think that it will not be appropriate for your study, you just ignore it. But you can read the Markov chain theory to see whether you can incorporate incorporate
Yeah,
that on your study.
Yeah, I just follow the literature, but I don't see any paper that use Markov chains. Maybe it can be a good tools. Maybe.
Okay, I have done a study and published in Review of Quantitative what they call finance and accounting. I can forward it to you through Mengs.
Thanks very much, Amidou. Very positive engagement with the paper. Very much appreciated. I have a show of hands from Aisha and then from Athena. So I'll take Athena first and then second Aisha. Athena.
Yes, hello, Standley, and thank you for this very interesting presentation.
Thank you.
So I have a question. You might have mentioned it and I missed it. It's not very clear to me what your sample is. So you're using US bank holding companies, right?
Yeah.
And you mentioned quarterly data.
Monthly data.
Monthly data, all right. The thing is that I don't remember which table it was at your presentation, but I think I saw 14 bank holding companies, if I'm not mistaken, which seems a little bit strange.
What? Repeat again?
So I don't remember what table it was at your presentation, but I think I saw that your sample consists of 14 bank holding companies, which seems very strange.
I have
yeah, this was in the last table. Yeah.
I think it was in the table when you were comparing the three estimation methods.
Yeah. Is the estimation methods?
Yeah, the question is that you have 14 banks, 14 banks. Yeah, you have 14 banks. So 14 and 14 is a small sample. So maybe you can talk, Standley, what might be helpful here is to talk about your sample selection. How you started with the universe and finally then you had to narrow down to a small sample of banks.
Yeah, because to simulate the KVA, I need the CDS contract, and I select only banks that have a CDS contract, and my sample is not only yes, it's 40 banks, but and it's a time series also. So I have I think I have 2004 and 2009 monthly data with 14 bed is and to simulate the KVA is take time. So if I have a big data, I will take one week to simulate the KVA. So I think this is okay for my data series.
Okay. Thank you, Standley.
Thank you.
Okay, thanks, Athena. I suppose that what Standley is trying to say is that there are variations in the size of the sample depending on the nature of the variable they are using. And where simulated variables have to be used, the sample then contracts. And maybe in the initial ones, the sample is larger. But I suppose the details are in the paper, which he has shared with us. So we'll be able to give further. Aisha, I couldn't read your comments in the chat, so you also should mention those because somehow I can't get access to the comments in the chat. So you have a chance to say all the comments you are thinking of.
Thank you very much, Standley, for your great presentation.
Thank you.
And my question is on actually basically on the capital ratio requirement, capital ratio adequacy ratio, whether you take into account varying risk-weighted measures, because according to Basel III, the capital adequacy ratio requirement is 8%, but each bank has their own measuring of risk weights. So did you take into account the weight, the risk portfolio for varying capital in the basket of these banks while taking into account their speed, adjustment speed, capital adjustment speed? Because I think to what extent risky if of their portfolio matters for their risk of adjustment.
Okay. I don't calculate the risk weight adjustment. I see I have this data for
you
each
didn't.
bank.
Yes, you didn't. But when because capital adequacy ratio also
I use
contains risk weighted assets. So risk weights are determined individually for each bank. So each bank has their own risk adjustment. So to what extent their risk weights affect their capital ratio speed of adjustment? Does this have any effect on this adjustment speed?
I don't think that each bank have a capital ratio that is the tier 1 capital over risk weight asset. So this ratio is each bank have the same minimum capital requirement. So a bank with a capital ratio lower is standard. This bank maybe this bank have too much risk or lower capital. So when we use the ratio, we don't have a difference.
So did you check that? That's my question. Is it consistent? Is this risk weighting consistent between different banks? Or they have their own risk adjustments, risk weighting for the assets in their capital adequacy ratio?
I don't check that.
Yes, because this might have an effect on their capital ratio speed of adjustment. Because if they use risk assets, it may well be the case that their capital ratio speed of adjustment is quicker. If they avoid, if their risk-weighted assets are not high, maybe it's for them a bit slow process for their capital ratio speed of adjustment. It may take yes. So I'm wondering whether these weighting measures, weighted adjustment is consistent across these 14 banks.
Yeah, I can do it. Yeah, I can use other variable.
Yeah, I can see I can see the difference in the sense that most recently some banks have started to report risk-weighted assets in their reports. So sometimes researchers may take the numbers given already without computing. But a little bit, a couple of years ago, it used to be upon the researchers to actually construct the risk-weighted adjusted capital components. I think in most of the work with ESOF, we had to compute these ourselves. So it's possible that even if you get the data that is already reported, it's possible to compute another one to be able to see whether the reported values differ in any way from the computed ones, and if so, what would be the implications? I guess that's what
Or if there is inconsistency, how this inconsistency would translate into the variations among your results.
Yes.
How risk weight adjustment differs your results.
Yeah, but I have only banks holding company. I think that is like a same category of banks.
Mm-hmm.
So I don't know if can be a change within these banks, because it is the same category of bank holding company.
Mm-hmm. Mm-hmm. Okay.
Well, I understand your comment. I will look.
Yeah, this will be interesting to
Yeah,
see if there is different applications based on the
yeah.
varying risk weight adjustments. So, okay, thank you, Stanley. Thank you.
Thank you.
Bye.
Thank you, Aisha. Any further comments or ideas to add to this? I'm just going through the. I don't see any other raised hand.
Yeah, there is.
Yusuf. Oh yes. Yusuf raised the hand. Yeah, okay. Yusuf, please go ahead. Yeah.
Okay, yeah, okay, thank you very much, Victor, and thank you very much to all people who made really great comments, actually. Yeah, probably, I'm sure probably, Stanley will get back to Amido and Charles, to get further references, on those references, actually, they mentioned in the intervention, actually. Yeah, let me just quickly, give some clarification on some of the question here, actually. I think there was this question of a sample size. Actually, basically, it's 13, bank holding companies. But if you take in terms of the time series, then it gives you, around, 840 banks month, data. Yeah, then the sample size seems to be okay with the time series, property year, actually. And the reason, why actually the sample size is 14 banks, actually, because to compute the KVA, and I will get to the KVA soon, the capital value adjustment, to compute the capital value adjustment, and the approach, actually, Standley is using, you use the data on the credit default swaps. And then he has to select it only the banks for which, actually, you could get those data, actually. That's why, the sample actually kind of showing to the number of banks, actually, which is in his sample. And for the capital value adjustment calculation, I know, Charles mentioned that was it, simulation or was it calculation and so on. I think, these are both, actually. Let me just quickly explain. The way, what Standley is trying to do basically is, because you see, with a new Basel regulation, if you add, actually derivative to your portfolio as a bank, then you have to compute actually the capital value adjustment. Then what Standley was trying to see was actually if you take each of these bank holding companies, and if they have actually derivatives in the portfolio, how much capital value adjustment they should have put inside actually in terms of capital. And then to compute that capital, if you take any time t, then you use the data from the banks and do the calibration, and then from that you have to compute the expected shortfall for the bank, actually. Then that's where the simulation is coming in, actually, Charles. Then you see, like, you take the data for the bank at time t, you do your calibration, and then you look at the next 10 days, and then you do your computation of your KVA. And that KVA is basically the capital the bank should have put on the side to cover actually these derivative transactions. And then it's trying to look at if the bank has a lot of derivatives in its portfolio and then has to put that KVA on the side, how should the bank adjust actually its capital to be able, to reach its capital level, actually, the target capital level? That was basically the exercise here, right? And that was the whole, the whole objective here. Stanley was trying to do actually with this paper. And basically, the exercise was basically trying to look at the capital adjustment for the all the banks, saying that okay, maybe because these are bank holding companies, they are similar and somehow. Let's look at let's say the capital adjustment speed is the same for all the banks, and then let's do the exercise. And another exercise he has done basically was to say, okay, each bank has its own target capital and also at its own speed of adjustment. Then let's do the exercise. If we assume that there is a big heterogeneity among the banks and each bank is trying to adjust its capital with its own speed. And then that also is done, actually in the paper, actually. Yeah. Then the heterogeneity part of it is taken into account, actually. Yeah. Yeah. And then in terms of the risk adjusted capital, basically, I think, this is always of the problem with this exercise. To compute the risk weighted asset, it's always hard, to be able yourself to compute the risk weighted asset for a bank if you don't have the full details on the assets of the banks, actually. Then what is using basically to do the capital, divide by risk weighted asset is using the risk weighted asset of the bank, and then using the tier 1 capital to compute, that one actually, yeah. That's just, the question, I shall raise, actually. Then the risk-weighted asset use is the risk-weighted asset, taken, from the bank, actually. This is provided by the bank. Of course, if you can compute it by yourself, it will be much, much better. But to do that by yourself, the risk is always to be able to get all the details of the asset and then to be sure that you are doing the right computation like what the banks are reported, actually. Yeah, these are the two things I wanted to add, to add here, Victor. Victor, we cannot hear you.
Your microphone is off, Victor.
If I sneeze, okay. Thanks so much. It's absolutely helpful comments. There's actually a very important dimension you brought out in this discussion, which possibly didn't come out in the paper area. It is the fact that the addition of derivatives, the addition of the those instruments on the off-balance sheet part of the bank is important in computing the KVA. I think the derivative argument held by banks is an important consideration. And again, those things differ from non-financial firms. So thanks for the additional clarification and for acknowledging some of the literature that will add to the discussion. Let me see if there is anybody who would like to come in again in this discussion. Amidu, I can see Amidu flashing. Or it's just, did you want to come in, Amidu?
No.
Okay, that's fine. Okay. Anybody who wants to come in? Okay. Let me just look at these issues with the look at another possibility. This work is particularly important in adding to the ongoing debates regarding implementation of Basel III, and in particular the construction of capital buffers by banks. And that's equally important for the US. It's very important, especially for the big banks, systemically important banks, and also equally important even outside the US in the case of further application of this study. The problem is specified, especially in the econometric modeling, in terms of an adjustment, which means you have a target, you are adjusting towards a given target. And that's very clear and beautifully done in the paper. Is it possible that one could look at this in a slightly different way, whereby by building a buffer, you are actually doing an adjustment between a certain ceiling, okay, and a certain lower limit. So you are working, the buffer has to confine within an upper limit and a lower limit. So that means you're actually looking at a threshold modeling type of work where the buffers have to move within these two. The buffers is this maximum and minimum. Otherwise, if it is falling below the minimum, then it violates the requirements of Basel III. Okay. The model would be different, slightly different. Okay. The analysis would be the same. It would be possibly very different, but it would be following some inventory type of inventory control modeling, where you are looking at the buffers with maximum and minimum values. Okay, I don't know what you think about this, whether it appears appealing. It may be, it's just a suggestion, it's not kind of a comment, but it's just a way of reinterpreting the targeting you are trying to do. The reason is actually why I think the working within the threshold model is that bank managers cannot fly blind, okay, and say we are going to meet this target, okay. They only want to make sure that they don't fall below the minimum, and they also want sure that because they can't just keep on targeting up to certain, a given value. They have to say the maximum, okay. Otherwise, also, of course, building capital buffers is a double-edged sword, okay. So there is a trade-off between the capital you're holding and the expansion of businesses. So that's why defining the maximum and the minimum becomes important. It's another idea. You just want to see how you interpret this, and maybe there are some limitations that make it inoperable, or maybe it's worth exploring. Yeah, just a thought.
Yeah, sure. Yeah.
So I think, but when I compute the counter-cyclical buffer, it's like I have a minimum value and maximum value for the buffer, but the buffer path is like the path of the cycle. When you see the graph here, so with this formula, I can
can you share? Can you share? Can you share the?
This, okay, you don't see.
You are still sharing. Okay, yeah, you can share.
Okay.
Yeah.
Wait a minute.
I mean, you can see it, but we can't.
Yeah.
Yeah. Okay. Oh yeah. Okay.
So for this formula, we have a maximum value that is the u, and so we have this parameter here. We can play with this parameter here to have an interval for the buffer. So the buffer path is the path with this cycle. We have the minimum here, the maximum here. So I don't know. It is to your point. If we can limit the buffer maximum minimum.
Yeah. But yeah, this size does not go into your modeling, right? It's an illustration of the countercyclical buffer. But when you go into your modeling, you have just an adjustment. If you just go into any of your econometric specification, it is the lambda you're estimating as a coefficient.
But I use this equation to simulate the countercyclical KVA, and then I use this variable and the estimation equation to compute the speed of adjustment.
Yeah. Of course, I'm not saying that what you are doing is wrong. I'm only saying that there is possibly another way of looking at the same problem.
Okay.
Yeah.
So you suggest that what you suggest again?
I think the inventory control models are slightly different. They are estimated differently, and this is not done in this paper. it would be a slightly different approach, although it would possibly inform the paper in a slightly different way. But I'm thinking of bank managers, the way they behave. Bank managers are finding Basel III very cumbersome. The bank managers don't like Basel III. Okay. And I remember myself and Yusuf in Nairobi, one of the bank managers telling us, they were being pushed towards Basel III, but I think they should go easy on it. And one of it is, expanding the buffer. How high can you expand the buffer? Okay. Yeah.
Yeah, but Victor, your suggestion will be basically if you take the equation where there is the adjustment speed, then it will be like an inventory model where you'll have a minimum. I mean, it will be in the range actually. Instead of
exactly.
going through the target because it's costly to reach the target. Then if you're in the range, then you just stop there. It will be, I mean, that the idea.
Yes.
Okay. Yeah. I mean, probably that's something I mean, Stanley can explore also.
Yeah. I'm not 100% sure it was work. Yes, was one of the things
sure.
You think when you are listening to an exciting seminar and you are saying,
but
okay,
also
if I was going to do it.
If you have any also reference on that, that will be good also to just send it to.
Yeah, good. Okay. Any other observations, comments, suggestions? Meng, do you see anything in the chat that we haven't taken up?
No, there's no more comment.
Okay, excellent. So basically, what remains for me to thank all the participants for being able to make it and to contribute to this discussion, and finally to thank both Yusuf and in particular Standley for sharing with us this very interesting work. Presenting a seminar always makes us excited researchers because it makes you even criticize your own work much more and understanding much better. But for Standley, I really want to give a standing ovation for him because I knew right from the start that he's more fluent in French than in English. But if we speak in French, then myself and many others would possibly have got a challenge. But definitely, I wish I could present a paper in French. But unfortunately, I can't. I can only speak. But you have been able to present the paper in English, and as well, you can create. So your bilingual skills have come through, and the need to present the paper in English has not diminished the value of your research. So that's absolutely interesting and delighted. So we indeed, thank you and wish you the best in your research. We hope that, like Yusuf and also like the other young man, Francois, that Standley, you will be participating every Wednesday in our seminar. So it will be your chance to give others comments on their work, paying attention to and give work. So next week, we have a brainstorming, panel discussion where we'll be talking about finance and, fintech and the COVID-19 challenges to many economies. So I do hope that you will all be able to come and participate in this in the meeting or seminar next week, 1 to 3. Okay, so thank you very much. I think there was some new information in the chats, but again, I can't read them. Meng, can you read them?
Yeah, so people are saying thank you.
Okay, people are adding their thanks very much. So thank you indeed, and see you next week, if not earlier.
Okay, thank you very much.
All right.
Thank you very much.
Over.